Okay, we're going to carry on with our Chapter 5 stuff.
We're going to do a little example where we talk about how to purchase inventory, right? Merchandise inventory. But before we do that, there's a few new accounts that we need to become comfortable with and another concept or two. First of all, this little list right here is accounts that we use when we use a perpetual inventory system. That's what we're always going to be doing, is the perpetual method. The periodic is shown in the appendix. We'll talk a little more about that as we go through the examples. The asset accounts, we have to deal with cash, plain old garden variety cash, and accounts receivable. We know what both of those are. They're assets. They have a normal debit balance. We do need to add a merchandise inventory account, because if we're going to buy inventory, we have to have a place to hold that and to own it, right? So we have this merchandise inventory account. As far as liabilities, we're going to use accounts payable. Remember now that in the merchandising scheme of things, sales is generally the account we use for revenue. And remember, sales has a credit balance. Now, it's important that a company keep track of how much is returned, right? Think about Walmart at Christmas time. People are lined up out the door bringing back all their crappy Christmas presents, right? Walmart wants to keep track of that, so they have this contra revenue account, sales, returns, and allowances. And if someone brings something back, that's where we book it, in the sales, returns, and allowances account. Gives us an idea about how much was sold and then returned. And then we have this account, sales discount. We're going to get into this discounts thing in just a bit. Also, a contra revenue account. So if you think about it, net sales would be sales minus sales returns minus sales discounts, right? Because they're both contra revenue. The other new account we have is delivery expense, plain old garden variety expense account, normal debit balance. And the one we've alluded to already in the first video is this cost of goods sold. These people listed, this book shows it as a cost. I think of it as another expense, and it's an expense that deals with inventory items. So if I sell an inventory item, the cost of that inventory item goes into the cost of goods sold, normal debit balance, right? So those are some of the new accounts that we're going to have to deal with, right? And let's take a peek at this credit terms thing, right? Now, if you think about it, it makes sense. If we sell something to someone on account, we'd like them to pay us quickly, right? So we can give an incentive for people to pay quickly. Same as when we're buying things, right? Our vendors will give us an incentive to pay them faster. So we have these things called credit terms, right? So we might have a credit term that just says something like N30, right? That just means that the whole invoice is due within 30 days, right? You make the purchase, and 30 days later you have to pay it. Okay, so that's one way of doing things, right? Now, the other way of doing things is there might be a discount. It might say, for example, 210 N45. Now, we got to read that all the way through. What that means is if we pay this within 10 days, we get a 2% discount. Otherwise, it's due in 45 days, right? So if we look at this little timeline, the date of the invoice, right? If I pay it within this 10-day period, I get a 2% discount. But if I pay it outside this 10 days, I have to pay the whole thing. Regardless, it's due within 45 days, right? It's due within 45 days. So when we talk about credit terms, we're going to see it written in this form, right? 210N45 or 315N60, right? 3% discount if we pay within 15 days. Otherwise, it's due in 60 days, right? So an incentive for us to get people to pay in a timely manner, right? Now, when we've got that done, we can